Argentina's inflation rate has increased to 4.7%. And if that sounds high, consider that this is only the monthly figure for February. Annual inflation in Latin America's third largest economy is above 52%. The conflict in Ukraine has added further volatility to prices in a country that has long battled soaring inflation. The cost of flour has increased by nearly 30% in recent weeks.
It's like a spiral, like a dog chasing its tail. Argentina hasn't been able to resolve the issue of inflation at the root cause for many years.
While Argentina has one of the highest inflation rates in the world, in the United States, they're seeing the highest inflation in nearly 40 years. And measures to combat the rise in prices will have a direct effect, not only on Argentina, but other emerging markets around the world. For the first time since 2018, the US Federal Reserve is set to raise interest rates this month to fight inflation.
Higher interest rates in the United States is bad news for emerging markets because the dollar is the currency in which most emerging markets borrow, especially in Latin America. So, more expensive borrowing cost is bad news.
Some analysts believe a number of Latin American countries are possibly better positioned to cope with the Fed's decision than they were in the 2000s or 1990s.
Some countries have developed the local financial markets. For instance, most of what Brazil borrows to finance the financial deficit comes from the local market, so they borrow in local currency. The same happens in Chile, the same is happening in Uruguay and Colombia. So the dollar part of the borrowing it tends to be a smaller part.
Yet at a time when countries face sluggish recovery from the economic impact of the COVID-19 pandemic and the conflict in Ukraine is setting off a spike in food prices, so the impact of the Fed's effort to tame inflation in the US will be felt around the world. Joel Richards for CGTN in Buenos Aires.